Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So when I first started, one of the things that I used to do, one of the people that I used to listen to a lot, and I still do listen to, and of course read his books and so on, is Peter Lynch. And what he always talked about, basically knowing what you own, and that stuck with me. I used to say, if I do not understand the business model of the company that I'm investing in, then why am I investing in? And there were some sectors that I found very easily, basically understood very easily, like what they do and so on, especially with technology side of things, because that's my background. There's some sectors that I stayed away from initially because of pharmaceutical companies, for example. It's quite difficult to understand the type of drugs and what they're doing and so on. I'm not a doctor, I don't understand these things. And yeah, there were some sectors that I felt like, you know what, I can actually invest in because I know they've got tangible assets that I understand and so on. And one of those sectors for me has always been the railroad companies. Railroad companies are basically companies that make money by shipping goods basically left and right. So within the US, for example, there are quite a few good companies. In the UK, I couldn't find a really good ones, but in the US, there are, between US and Canada, there are a few good companies. And what I would like to do today is share with you guys three companies that are railroad companies, and one that is a technology company but that provides basically technology products for railroad companies. So I'm going to share that with you guys today. If you are interested, because these type of things, and you want to learn more about investing in the stock market and so on, just join us in the Patreon account, where you learn a lot about basically you see all the buys and sells that I'm making regularly, the monthly undervalued stocks that I've updated recently. There's about 20 something different companies that basically are on that list. And then you've got a Discord where a lot of brothers genuinely are sharing good practices on a daily basis, and which is quite nice to actually join and so on. So what I'm going to do now is I'm going to go over some of the basically these companies. But before I do, I just want to talk about mainly the overall markets, if you like. And as you can see here, we are down for the year, for year to date. But again, when you think about for the 1 year and so on, things are slightly different. So for 1 year, we're up. For the last 5 years, we're up quite a bit. So I wouldn't worry too much about it. So when you look at the sectors that are dragging the overall market right now, it's a lot of it's technology companies. So we're looking now at the S&P 500 plus. Okay, so this is not just the S&P 500. And for the 1 month, as you can see here, majority of the companies that are down, for example, Apple and Google are basically down about 11%. Meta is about 14%, and basically Amazon is about 11%. Then you got Tesla, that's down almost 30%. So the Magnificent Seven, so the Teslas, the Amazons, the Metas, Google and Apple, and of course Microsoft and whatever, Nvidias and so on, they're all down a lot. So and for that reason, they're dragging the rest of the markets down. Of course, Broadcom is actually down a lot as well. And remember, these companies, they drag the markets down because they have a massive market cap. So with companies like Apple, for example, and Nvidia and so on, the top two, then you've got Microsoft, then you've got Metas and Amazons. I don't even know which one is bigger anymore. But one thing we need to look at is have a diversified portfolio, because if you bought basically technology companies only, right now you'll be feeling the pain. If you bought companies, for example, diversified, and you've got quite a few healthcare companies, then you'll be smiling right now, because a lot of the healthcare companies, apart from the one I've been buying, Novo, have actually gone up quite a bit, which is quite nice to see. There's a bit of a rotation, if you like. That rotation is actually money coming out from basically these companies going into healthcare, for example, a bit more defensive kind of companies. We talked about recession-proof companies in the last video. If you haven't seen that, go watch it. Then you've got the, for example, household companies, like the, for example, consumer defensive. There's a reason why they call that, because these are companies that sell products that we normally use. You just go to the basically Tesco's and whatever else there's, and just grab whatever you can find, or the Walmarts and so on. And you just grab it because that's what your family needs. Okay, oil companies are basically making a comeback. They've not done well over the last year, but 2022, when technology went down a lot, basically they were doing really well because the oil price has gone up. So if the oil price is bouncing back, then of course these companies will tend to do well. So it's quite difficult to be a individual basically stock investor, because you're going to have to build a portfolio of all of these sectors and all these companies and kind of build your own ETF. That's why I said to, if you're Sharia compliant investor, then you're better off buying one of the ETFs and just forget about it if you don't want to go through the headache. But if you like the headache like I do, okay, I don't like the headache, but of course I like investing in individual stocks and researching about them. And then you need to build a portfolio that's actually that has different sectors. So it's important to then look at each sector and say, who are the best companies in that sector? And today what we're going to do is basically look at the railroad companies, okay, and then talk about some of the big boys in this sector. And let's start that. So railroad companies, before I basically talk about the individual companies, you should invest in these companies because, you know, they basically kind of copy what's happening in the overall economy. If the economy is booming, everybody's basically getting goods left and right, you know, buying and selling goods, then of course these companies will do well. They also have a really good dividend. So when the economy is doing well, these companies do tend to do really well. They have excellent dividend, growing dividend, a lot of them that have been, you know, basically they've been paying for quite some time. And also it's a barrier to entry, so they have a wide moat. So the barrier to entry for these companies is very, very high, because nobody's going to build in new tracks basically from scratch. They're too expensive. Okay, and then efficiency gains, for example, they're using a lot of technology these days to make it basically to boost their margins, if you like. Some of the risks for these companies are, for example, high capital expenditure. So the railroad, something happens to the actual train or something happens to the basically the track, they have to fix it. It takes a lot of money and manpower and so on. Exposure to commodity cycle as well is another thing. It basically like a cold demand. If there's a demand for that type of product, these companies tend to do well. And the next one is the regulatory and the local, basically, and labor issues. So regulatory is quite difficult, and on top of that, you've got labor issues, basically. And the final thing is sensitive to fuel prices and economic downturn. So fuel prices go up, these companies, of course, basically they have to start charging more. The margins get squeezed a little bit, so it is quite difficult. What I'm going to do is now I'm going to share with you 5 companies. The first one, we're going to do 3 companies, and then the 4th company will be a more or less technology company that has product for these companies, basically. So they're kind of related. So Canadian Pacific Kansas City Limited is one of the first one we're going to look at. The dividend side of things is not a lot for this company, so it's just less than 1%. They have a safe dividend, which is good. It looks reasonably valued right now, and they're not growing the dividend as much as I would have liked, but triple B plus for in terms of credit rating side of things. If we look at this, you can see they haven't increased it recently, but the last 4 years is about 4%. So it's slightly slow. But when you look at the last 20 years, that's when you actually like it. If you own this company for the last 20 years, you would have seen about almost 11% growth every single year. Now, of course, they haven't increased it recently. You get 53 cents. So it's not a lot, but it's actually, and hopefully if they can start growing that dividend, that will make a huge difference to actually overall. Now, in terms of the price wise, it says here looks reasonably valued, but you can see that line there is basically the average has been over the last whatever years, and right now it's actually coming back down. So it looks like it's probably going to become sooner or later, if it continues this way. If we look at the stock, in fact, one of the things that we will see is a year to date, for example, has done nothing. For the 1 year is down about 20%. So if it actually comes down basically for another 4-5%, they'll probably become very much undervalued if you're looking forward to that, if that happens. So if you look at the earnings payout ratio, so it's about 15%, which is really good. Free cash flow payout ratio with only 21%. You can see earnings per share is heading in the right direction. It's growing every single year. Free cash flow per share, it's growing every single year, which is nice to see. Now, they have been basically buying back their own shares, but 2021, that's when they started actually the merger, I think, probably. Maybe, I don't know why they actually diluted the shares that much, but they've actually started diluting your shares. Total sales is actually heading in the right direction, which is nice to see. Return on equity will go up by 8%, return on invested capital about 7%, and operating margins about 39%, and free cash flow margin of 17%, which is nice to see. Now, if we go back here and we look at, for example, earnings expectations, in fact, let's look at the financials first. As you can see here, from $4.8 billion in 2015 to right now $10 billion, and about take home, it's about gross profit about $5.2 billion. They don't spend a lot of money in these basically research and development side of things, but net income, we've got $2.5 billion, which is quite nice. EPS is growing from $1.22 to right now $2.77. Again, remember, these companies is very difficult for them to grow that fast. If we look at the basically balance sheet, if we look at the liabilities, so current liabilities 2.3 against current assets against current liabilities, which is about 3.9. So they have more liabilities, okay, than actually basically current assets, which is not great. But when you look at the total assets of $61 billion and against basically total liabilities, which is basically 27%. So in the long run, the company is absolutely fine. But right now, next 12 months, basically that's not great. Looking cash flow here, okay, I'm interested only the free cash flow side of things. You will see basically, if you look at this, from 500 million to right now $1.6 billion, which is quite nice to see as well. Now, if we look at the valuation side of things, Refinitiv Ratings basically saying it's about $93 per share, almost $94 per share. Right now it's $71 per share. And then if you basically, that's about 30%. If you look at the tip rank, for example, they are saying it is a moderate buy, 15 buys, 3 holds and 1 sell, $90 per share. That's the 25% upside from where we are currently. And if we look at the Morningstar valuation, it's about $73 per share. It's right now, so it's about 1% higher from where we are, and the company has a wide moat. So you can have, I'll share with you guys this at the end so you can have a full picture. Okay, I've put all that information in one place. The next one is Canadian National Railway. And this one is actually, it's got a better dividend yield, 2.5%. And it currently, it looks like it's actually undervalued. They grew that dividend recently about 5%, which is quite nice. They got nice dividend safety, or very safe, 97%. A- rated when it comes to credit rating, 60 billion market cap. So it seems slightly better. If you look at the 5-year average, basically the latest increase, and then if you look at the last basically 5 years, last basically 20 years, it's absolutely done absolutely amazing. So overall, the sales were declined about 13% basically last year, in the last recession, and about minus 45%. Remember, 55% is where the S&P 500 declined between 2017 to 2019, about 55%. And if you haven't seen the video where we talked about recession yesterday, please go and watch that video, because it is important to understand like this kind of thing can happen. So imagine 3 years in a row of basically markets declining 55%. And basically your portfolio is just like going down every single week. Can you stomach that? Can you actually like be honest with yourself and say, yeah, I will be okay? And if you can't, then you need to get out of the stock market, because that's the kind of thing that can easily happen. But over a period of time, 10, 15 years from now, you'll look back and say, alhamdulillah, I stayed basically on the course, because I've made a lot of money between then. 28 years of increasing that dividend, $2.45 is what you will get. Valuation right now looks cheap because it's gone below that line. That line is where it has been over the last 20 years, last 5 years. Okay, and when we look at the things like earnings payout ratio, for example, about 44%, 60% when it comes to free cash flow payout ratio, slightly higher. Earnings per share is heading the right direction, which is nice to see. Free cash flow per share is heading the right direction too. They're buying back those shares. Total sales is actually going basically the right direction. Return on equity about 22%, return on invested capital about 13%, operating margins of 40%, free cash flow margin of almost 20%, and the debt levels is actually okay. Now looking at for year to basically for the 1 year is 27% down, a year to date almost a 5% down. If we look at the financials for this company, you can see from 2015 it had a $9 billion to right now about 11.8. 6 billion of that basically is a gross profit right now, and then the net income for this company here, it's there we go, $3 billion right now. EPS is also heading the right direction from $3.18 to right now $4.88. Now if we look at the balance sheet, just again remember these companies carry a lot of debt, so you have to be mindful of that. Total current assets is 1.8, total current liabilities, and we're looking at about 2.7. So that is again the similar situation that what we've seen with the first one. But when we look at the total liabilities, total assets against total liabilities, we got basically almost $40 billion of total assets against total liabilities of 25. So nothing to worry about in the long run for this company for the next 12 months. Basically, they might get into trouble. However, they do have some free cash flow, as well as, of course, that they can sometimes use debt to pay off some of these things. And if we look at the basically free cash flow here, we're looking about from $1 billion to right now almost to $1.8 billion, which is absolutely fine. Looking at valuation side of things, if we go to my favorite website, Interactive Brokers, if you go to analyst ratings, for example, what you will see is the Refinitiv is actually saying is about 30% down upside from where we are. $125 per share is where they think the price should be, and it's a buy rating from them. Tip rank is actually saying is a moderate buy, 12 buys, 6 holds and 1 sell, $111 per share, 20% upside from where we are. Morningstar is saying is $106 per share. It's quite close to where we are right now, so that's not basically that doesn't give us a lot. But if it comes down maybe to maybe another maybe $90 per share, then maybe this will give you a little bit of a margin of safety, which is basically something that we always talk about. And the final company we're going to talk about today is that's railroad companies, because we still have one more company to go, and is Union Pacific. Union Pacific is one of the companies that I've had in my portfolio a very long time. I actually had it in the family portfolio, but made a little bit of profit, sold it, because that portfolio I just wanted to be tech heavy, if you like. So dividend yield right now we're looking at about 2.2%, 88% safety, A minus rating and credit rating. Valuation looks reasonable, 3% dividend increase recently. So if we click that, you can see that 3%, 7%, 7.4% in the last 5 years, 15% of the last 20 years, if you like, and then 18 years of increase in that dividend. $5.36 is what you will get right now. Like we said, it looks reasonable in the last 20 years, last 5 years. It also looks basically reasonable, so it's within that line. There was at some point, I think I was buying this company around here when it was trading less than basically $200 per share, and that was basically the best time to buy that company. But right now it's within that line, which is absolutely fine. And then if you look at the, for example, earnings payout ratio is 45%, free cash flow payout ratio 51%. But as you can see here, earnings per share is actually heading in the right direction. Free cash flow per share is also heading the right direction. They're buying back their own shares. Sales is increasing, which is quite nice to see. Not massively, but they are do increase. But remember, these companies do fluctuate in terms of, they're very cyclical too, basically, because the economy, if the economy is doing well, they do well, basically. Return on equity 43%, return on invested capital about 16%, operating margin 40%, operating free cash flow margin 24%, and then the debt levels is actually low. Now if we go here, and you see here almost 6% down for the year, for the 1 year. A year to date is actually up almost at 3%. If we go to the financials, you can see here from $21.8 billion to right now $24 billion. $13.5 billion of that is gross profit this year, and then the net income for this company is about $6.7 billion. And if we look at the EPS, is basically has grown from $5 to right now $11. Now looking at again balance sheet, we need to check that debt level side of things. We need to see their current liabilities against current assets, so $4 billion in terms of current assets against current liabilities of 5. Again, similar thing, we have more liabilities currently than actually basically in the long run. When it comes to more than assets, $67 billion in terms of total assets. In terms of liabilities is 50. So that again a similar thing. All of the companies that we looked at today have similar sort of a situation when it comes to basically long-term liabilities against long-term assets and so on. Now looking at the free cash flow side of things, as you can see here, we've got $1.4 billion to right now $4.6 billion, so nothing to worry about. Now in terms of the valuation side of things, about 13% upside from where we are, including the according to Refinitiv ratings. It's a buy rating from them, $265 per share is where they think the price should be. Tip rankings is actually saying is about moderate buy, 12 buys, 5 holds, 1 sell, and you've got $263 per share. That's about 12% upside from where we are. Morningstar is saying $220 per share. Right now we're looking at basically $233 per share, so it needs to come down a little bit to hit that sort of to also giving yourself a margin of safety. And the final company I'm going to share with you here basically on this list is this company here, Westinghouse Airbrake Technologies Corporation, $31 billion market cap. It has a narrow mode, price right now $184 per share. Like I said, this is the company, technology company, that helps these companies do become more efficient in terms of what they do. You can see the dividend is actually decent. It's not that bad. The safety is 99%. Profit margin, return on equity, return on invested capital is decent. Free cash flow $1.6 billion. They're expecting the earnings to grow about 14%, revenue to grow about 6%. And then Morningstar is actually saying about basically it's expensive right now. So all the companies that we talked about today, I haven't shared this with you guys, but you can see every single one of them is expected to grow their earnings and EPS positively in the next couple of years. So overall, I really like this tech sector. It's probably one of the easy ones to invest in, to understand. For me, out of all of the ones that I've shared with you guys, I do own this one here, and I'm keeping an eye on this one here, CNI, Canadian National Railroad. If I can get this in basically below $100 per share, below $90 per share, then potentially I will be adding to it. That will give you a little bit of margin of safety, although it's about 8% from where we are right now. If I can get maybe 10 to 15% margin of safety, that would be absolutely amazing. And with the tariffs and everything else that's happening, I wouldn't be surprised if I get that opportunity very soon. I'll share more information with you guys in on when I get more information, when basically this company comes down and so on. But yeah, for now, if you are enjoying this content, it takes a lot of time and effort to put these videos together. I would genuinely appreciate if you can join us on the Discord and the Patreon account side of things. Have a wonderful day. Assalamu Alaikum.